How's it going, guys? Today, I'm going to teach you my day trading strategy that you guys can use to help you make money every day. Um, so yeah, let's get into it. The first thing I do every single day is I'm looking for highs and lows, which are draws on liquidity. So let me show you a couple examples here. So if we go on the 4 hour, liquidity is always resting between lows and highs. So in order to classify a high, we need to move up and then a move down. So a green candle and then a red candle. And then vice versa for a low. We need a red candle and a green candle, and that's a low. And you always mark out a low or a high by the lowest wick. So you don't want to put it on the body, you want to put it on the wick of the candle. Perfect. So as we can see here, those are lows and highs. But what's liquidity? So liquidity is where um, resting orders are that need to be filled. So for example, let me see if I can find a good example here. Yeah, this one will work. So you can see here, we have this low here, um, this pretty prominent low here. And then you can see here, we got reactions out of that. We move up off of that. Um, and then we actually reverse off of this because of this imbalance up here, most likely. But you can see here, there's liquidity resting below here, and then orders were filled up, and then price came back down to this area, swept this liquidity. This is what we call a liquidity sweep. Swept this liquidity so more orders could be filled, and then rallied and pushed even higher. So, and that's pretty much what I'm trading every single day. It's just liquidity sweeps. So this on the bear bottom level is a liquidity sweep. You mark out a low, wait for price to push below it, and it'll rally most of the time. Don't just trade off of that. You need other confluences to go along with it. But that's the bare bones of my whole strategy. So I'm looking for liquidity above highs and lows, and then I'm looking for that liquidity to be swept, orders to be filled, looking for reversal, confluences, and then price to push the other way. Another example is right here. We'll show a sell off. Yeah, so right here on the hourly, we have this high right here, pretty prominent. And I'm saying prominent just because it's easy for me to show you guys, but there's liquidity sweeps happening on every time frame, um, on any scale, every single second, pretty much. So we have this high here, and then you can see price pushes up or pushes down after it. We fill orders here just because where we are. You can see price pushes down off of that. We get pushes up, sweep this liquidity, and then push lower. We never push below this, but we do push down because we fill more orders here. We've reversed off of this liquidity and pushed lower. So that at the bare minimum is pretty much my strategy. I mean, that's all I'm looking for is a liquidity sweeps is the first thing that I look for. So for draws on liquidity, let's see if we can get back to this. So draws on liquidity. 4 hour highs and 4 hour lows and 1 hour highs and 4 hour lows. So we have 4 hour highs and lows and 1 hour highs and lows. And you want to go ahead and mark those out. So I'll go over an example with you guys for the trade I took today, which was a perfect example of my strategy. So if we hop into the 4 hour here, we can notice we have this high here because it's a move up and a move down. But you can notice here, this candle actually sweeps that out and we get pushed so down off of that before market opens. So the first thing we actually want to do is make sure we're paying attention to when market opened. So market opens at 9:30 for New York Open, New York Stock Exchange every single Monday, Tuesday, Wednesday, Thursday, and Friday. Normally, if there's not a bank holiday. But you can see here, that sweeps before market opens. So I'm not going to mark that out. There is a low here, but we do not form this low until this candle closes, which is not till 10 a.m. There's this low all the way down here. And then if we hop into the 1 hour, we can see a couple highs here. We have a move up and a move down right here. We have a move up and a move down right here. And then a couple here, but those were already swept. You only want to mark the most recent highs and lows that haven't been taken out yet. And then we have a low right here. And then there's another one down here, but that was taken out. And there was one here on the hourly. So perfect. Now what? So next, like we were talking about, we want to wait for a liquidity sweep. So we want to wait for one of these levels to be hit, either this one or one of these. And that'll help determine our bias for the days, for the day. So if we see a high get swept, we're actually going to want to look for shorts. If we see a low get swept, we're going to look for longs. So let's go back to our what we're doing here. So 4-hour highs and 4-hour lows for draws on liquidity. Next, we want to wait for that liquidity be swept. So liquidity sweep. You want to wait for liquidity sweep. And then we can see that just by watching the chart and seeing price push into this into these highs right here, or it could push into these lows. But once we do that, we want to go on to the 5-minute for my strategy. So let's move this down here. So liquidity sweep, and then we want a 5-minute retracement. And all that means is we want to see that liquidity be swept. We want to see a push down and then a push back up. So we want to, if we're taking out a high, we want to see a green candle up, a red candle down, and then a green candle back up, which you can see, we see here pretty much 30 minutes or so after market opened. But we get this liquidity sweep right here, waiting for a red candle, then a green candle, still get a green candle here, get a red candle here, perfect. Here comes the retrace. Boom, then we get a green candle. This candle closes at 10:25. So 10:25, at 10:25, we're going to hop into the 1-minute time frame. In the 1-minute time frame, let me just back up one step here real quick. If we go in here, we use this liquidity sweep to determine bias. Like I was saying, if we sweep a high, we're going to want to go to short. If we sweep a low, we're going to want to go long. But yeah, 10:20. Let's hop on over here. It's 10:20. What do we say? 10:25. And then after the 5-minute retrace, we're going to want to hop into the 1-minute time frame. And then we're looking for a 1-minute fair value gap or a 1-minute order block or a 1-minute IFVG, which is an inverse fair value gap. I mainly look for just a fair value gap. And then after the fair value gap, I like to see a continuation of structure on the 1-minute after our confluence. So after we get a 1-minute fair value gap, 1-minute order block, or a 1-minute inverse fair value gap, I want to see a continuation of structure on the 1-minute. So that's basically just a break of structure, but if it already broke structure, it's technically not a break of structure, but it's just called a continuation of structure. So perfect. So we get this retrace here, 10:25. Let's see if we can find it on here. 10:25 right here. Yep. We have this gap here. in this price. We have this this decent sized candle that has this gap that no wicks surround it. You can see there's no wicks here and no candle wicks here. This is what we call a fair value gap or an imbalance. This is an imbalanced price range. See how all these candles here, these wicks overlap, um, and then there's no big gaps. So when we have these big gaps like this one or this one, we want to make sure we pay attention to those and mark those out. If you're new to this, I would mark every single one you see out, especially if it's in line with your bias, because this is ultimately what helps you enter your trade. Because what's going on in here, there's also more liquidity in here. So like we saw earlier, when we sweep liquidity, we get moves out of them. So that's pretty much what we want to see with these imbalances. We want to see price push into them and then have a reaction out of them, which is what we see here. We see price push into this imbalance right here. It forms. So another thing here is fair value gaps are a 3 candlestick pattern. This one here, this one here, and this one here. It creates this opening gap, or this gap here with no wicks intersecting or like crossing over each other. And we call this fair value gap or an imbalance. This is just a normal fair value gap. I'll talk about an inverse fair value gap in a minute. But we can see here, mark that out. Just go from this candle wick to the other top candle wick. And you can see here, this candle closes, this forms a fair value gap. We immediately get pushed into there, which is good. So the orders get filled in there, pushed back out, and we form this down candle here. But first, we have this candle closing up creates a low. And this here is what I mean by a continuation of structure. We have a structure continuation, but basically it's a break of structure. But we already broke structure here, but it's basically a break structure, but it's a continuation because we already broke structure. I'm kind of confused, making that confusing, but it's not that confusing. Just whenever, what I want to see is a low get created, and then I want to see a candle break through that low and continue down, which is what we get here. Candle closes below this line. Perfect. That's all I need. And then I enter. I go short right here on this candle close. I like to put my stop loss right on this candle high. Maybe just space it out a little bit just because spreads and things like that. I always like one of my take profits to be a 1-to-1 risk to reward. Just so, because that's basic level, the basic amount you should be winning. So might as well take that trade and win that profit and lock it in at 1-to-1. And then maybe you can target 15-minute lows or other draws on liquidity, even if you want to. Here, if you want to target this 1 hour low, which was my final TP on the day, it's a 3-to-1 or 3-to-2, 1 to 3.2 actually. Because like we said, liquidity is resting below this, and price will eventually will go below this low. But what happened today was I got my TP1 hit at a 1-to-1 risk to reward ratio, and then I moved my stop loss to break even once I hit 1-to-1, and then I got stopped at break even right here. But I am up on the day. As you can see, I made $170 today in less than 20 minutes with me entered. I started looking up charts at 9:20 or so. So I worked for 80 minutes today. So an hour and 20 minutes or so. And I made $170. And this was a lower day. So can't complain about that too much. But yeah, that's basically my strategy that I use every single day. Another thing I'll show you while we're here on the 5-minute. is an inverse fair value gap. This can be a 1 minute confluence if you want to use it, but there was one on the 5 minute I'll use to show you guys what's going on here. So you can see here, right here, we have this imbalance here. Remember, I said mark out all these imbalances here. These are important, very important areas, and price will likely retrace to them. You can see, boom, we have this imbalance here. What do? Price pushes through and breaks through it. So it doesn't fill and push out of it. It actually pushes through and breaks through. And you can see here, price moves lower. So when this is what we call an inverse fair value gap, because this candle inversed this fair value gap. So how can we use this? We can use this because if you see a candle inverse this gap, it means there's a strong push, strong momentum in price to go that direction, whatever way it inversed. And you can see that's what happened here. We inverse it, push lower. So when you see an inverse fair value gap like this, you almost, especially in the 5 minute, you're going to see a push lower. Might not be super big, but you're going to see a push lower. And like you can see, if we didn't push into this, we probably would have just pushed all halfway or so into here and then pushed even higher. But price moves on its own, and you just need to be able to adapt to it and see how it's reacting and react to the market. The market's not going to go your direction because you entered on a trade. You need to be able to read the market and understand where it's going and why it's moving that way. But yeah, pretty basic. I mean, my strategy is super simple. I'll go over it real quick again. Let's see if we can find our list. So first thing we want to do, we want to see the 4 hour, we want to find the draw on liquidity. And what's resting above liquidity and below liquidity? It's resting orders. And what happens when they get filled? Price is likely to reverse, and price is likely to reverse, and you can use that to your benefit because you can take a trade off that. So first thing we do is mark out hourly highs, 4 hour highs, and lows. Next, we want to wait for those highs or lows to be swept, which is what we call a liquidity. So we use that to determine bias. So if a high gets swept, you can add this here. High gets swept. We're looking for shorts. If a low gets swept, we're going to be looking for longs. And you can see here, like I just talked about, you swept a high, I took a short. Pretty simple. After that, we're on the 5 minute time frame. We're looking for a 5 minute retracement after liquidity gets swept. We want a retracement on that liquidity. And then we don't want it before we sweep because it's absolutely pointless. We want that liquidity to be swept, and then we want to see reactions out of it, which is this retrace. And then after that final candle close, this retrace is I guess it's technically a 3 candle pattern because we need that move that sweeps. It could be more candles, but we need the move that sweeps. We need the retrace back down or reverse. We need a reverse candle from whatever way we were, and then we need the back up or back down depending on what candle we need. And pretty simple. I mean, it's a retracement. And then after that, after we get that final candle close, that final retracement candle, we're on the 1 minute time frame looking for a 1 minute fair value gap, a 1 minute order block, or a 1 minute inverse fair value gap. And if we get that, and then we get a continuation of structure after that confluence, then we can enter. We don't want to enter before we get a continuation structure because if we don't get a continuation of structure, price could reverse and push through all these things. So I like to wait for the continuation of structure. This has saved me multiple times. I've tried trading without it and I end up losing. So I always do that, wait for this. And that's just another factor to keep you safe. Some people don't use it, but I like to. Sometimes that'll keep you from making super big risk reward trades, but I think the safety net's nice. So I'm going to keep doing that for now. But it's pretty simple. It's one, two, uh, three, four, five steps, maybe at most. We have mark out highs and lows, which is one. Let's number these. So one. Liquidity sweep to determine bias is 2. 5-minute retrace is 3. 1-minute time frame, 4. Yeah, 5. And then 5 is continuation structure. 5 steps to make money. I mean, it's pretty simple. And if you stick to this, you master your risk management, you master your psychology, you master your emotions, which is a big part of this, then I guarantee you'll be profitable. But yeah, that's my strategy. Pretty simple. Um, some of this I've learned from other people. Some of it I came up with myself. Um, but yeah, there you guys go. I have 5-step day trading strategy that I'll use to be profitable, that I use to make money. Hopefully to help you guys out. So yeah, thanks for watching. If you found this helpful, like, comment, subscribe. Hope you guys enjoyed. Let me know how your trading's going. We'll see you later.